Good morning, everyone. Welcome to this update for global stocks and commodities for the 4th of December. And there was a little bit of consolidation, a little bit of a pullback through the week, but that was to be expected given the enormous moves that we've seen since the US election. Most sectors higher, in particular financials, energy, materials. Some sectors lower, obviously precious metals is one of those, but also consumer staples, utilities. So it's been definitely a market in two halves. Some stocks doing extremely well, and some stocks not doing well at all. Let's examine the way that it sits at the moment, but a lot of this could change, of course, because we've got the very important Italian referendum election, which we'll probably know the result of by maybe around about mid to late morning Australian time tomorrow, and that could have a significant effect on financial markets. I suspect probably not as great as Brexit and Trump, because neither of those outcomes were priced into the market, whereas I think there's a very realistic chance that the no vote might prevail. And that will have significant consequences down the line. But I'm not sure that the market is going to react as violently as it did to those other two events, which were pretty unexpected. So let's take a look. The S&P was down 21 points on the week, and we just saw a continuation of this sector rotation that is going on. Financials were strong in America, and the money for that had to come from somewhere, and it came out of technology stocks. The Facebook, Amazon, Netflix, Google kind of play that is the FANG stocks that has been in vogue for a number of years. So certainly some of money came out of that. So for November as a whole, US financials were up 13.4, industrials were up 9, energy and materials up around 7. So those sectors all doing very well, and they're really more growth orientated and rising inflation orientated sectors. Technology was essentially flat, but I read that as not that there's any particular problem with technology. It's just that the money to finance the rotation into other areas just had to come out of somewhere, and that was one of those areas. And also consumer staples. Utilities, which is obviously has done very well during a period of very, very low inflation and low interest rates. That's reversing now, and that's happening around the world. From a sentiment perspective, which is obviously what drives markets in the short to medium term, if you look at the big picture, there's still a very bearish sentiment, which from a contrarian point of view is positive. The fact that we've had a 7, nearly 8-year bull market, and the sentiment has never become really euphoric, which is what really happens around a market top. So while we retain this very bearish sentiment, it really is hard to see a long-term top in the stock market. One is coming, there's no question about that, but it's not currently on the horizon for factors that I've talked about now for nearly 2 years. Also, US valuations. Even with interest rates kicking up a bit, valuations continue to support where the market is at the moment. It's slightly above average. And yes, we might get a bit of consolidation, and yes, we might get the odd bit of panic if the Italian referendum result goes the wrong way for the market. But they're all just short-term things, and corrections of 5 or 10% are just part of being in the market. So the way that I see it from a big picture point of view, the market is heading higher, and there's every reason that it will continue to head higher. However, short term, the hot sectors, financials, industrials, energy, materials, have really got way too bullish. Now, that comment relates to America. It's not quite so applicable to Australia because our market has not responded in quite the same aggressive manner. But certainly short term, those sectors are way, way above where they should be. In terms of deviation from recent trends, and that's just really begging for a bit of consolidation. So let's take a look at the S&P. Now you can see we've had an enormous run up from the 4th of November, and I think we got 13 or 14 sessions in a row that were higher or very close to higher. We've now had 4 or 5 sessions in a row of slightly lower, and we've basically pulled back to this breakout, which is pretty much where you'd expect it to be. Now, that doesn't mean that it can't pull back a little bit further. And if we put a Fibonacci scale on here, you'll see that we could quite easily pull back to the 2160 or even 2148 area, and that wouldn't dent this uptrend, the overall uptrend, one little bit. I mean, even the 200-day moving average is still down around 2110, which is still another 80 points down. So we could pull back to the 200-day moving average, and that wouldn't negate the trend. So we'll have to wait and see whether this is the low or whether we get a lower low, depending on what happens in the Italian referendum tonight. Remains to be seen, but it doesn't change the bigger picture, that's for sure. Now, the Nasdaq has been struggling a little bit comparatively because a lot of the money has come out of technology and got into financials, as I indicated. So the Nasdaq is underperforming in the shorter term. If we look at the Russell 2000, yes, it's pulled back a little bit, but it just had an absolutely meteoric rise. So it had changed from a breakdown, and it looked ugly, to this amazing rise, just basically overnight. And now we're getting a little bit of consolidation of that rise. Turning to the Australian index, we've had also the same good rise off the lows in early November. Not as strong as the American market, and we did get a bit of a pullback on Friday. So overall, we were down a little bit on the week in the Australian market. The Australian dollar pushed just a little bit higher to 74.5. I think it was up about 0.2 on the week. But our index ended up 64 points lower for the week. Now, anyone who's in the market and owns some of the better performing stocks of the last 2 or 3 or 4 years will know that there's been some absolutely brutal treatment being handed out to these stocks for even minor misses of expectations or temporary slowdowns in the business. And sometimes those slowdowns are orchestrated well in advance, they're necessary, and they're telegraphed to the market well in advance. I could think back 10 years ago when a stock missed expectations. On the first day that the announcement came out, you would tend to see price falls of 10, 12% was pretty normal. And then the price may decline further over the coming weeks. What we are seeing these days, however, is absolutely almost instantaneous brutal plunges of 25, 30, even 35%. And we certainly have seen quite a few high-profile cases of late. TPG Telecom. We've seen it with a company called Vita Group. We've also seen it with Vocus Communications, and just on Friday with Bellamy's. And Bellamy's ended up down 40% on the day. This is the advent of computer trading algorithms, where the computers are just basically taking over, triggering stop losses, and the selling is just absolutely brutal. The price of Bellamy's fell 30 or 35% almost instantly. So this is just the reality of the sort of market that we're in these days, and it really underscores the importance of getting, not taking big bets on any individual stock. Making sure that you've got a good cross section of the good performing stocks. Don't be overly exposed to anything in particular. Now, resource juniors are certainly getting plenty of attention in the Australian market, and that's been a theme over the last few months. There's a bit of speculative froth in some sectors of the market, but you've got to remember we are coming off a fairly low base. Resources have been smashed since 2013. So while some of them have got ahead of themselves in the short term, and there's a lot of rubbish that's also rallying, you've got to be careful of those. there's certainly money flowing back into that sector. And there's also quite a few niche emerging industrial companies that really are pretty exciting, that are really particularly built around technology. Some very exciting things there. Now, turning to precious metals, prices are falling, and I mean, that's the reality. It defies some of the bigger picture fundamentals when you look at all the things that could go wrong, particularly in Europe, with their banking system, and perhaps the impact on the eurozone. But it's the reality. Prices are falling, but they've fallen a fair way. Sentiment has become incredibly bearish. Gold stocks now are hated, and that's the sort of environment where we do find bottoms and turnarounds. So let's consider what could reverse that situation. And I've been saying that there's a lot of drivers with gold, and obviously the US dollar going up of late hasn't helped. But it's not the main driver. We've had periods before where the US dollar has gone up and gold has gone up at the same time. What gold really requires to get some upward momentum is to see a breakout in inflation and or a breakout in fear. To me, they're the two main drivers. So a disorderly unwinding of the bond market, and I've been talking about this now for months. Whether it's orderly or disorderly remains to be seen. I find it difficult to believe, given the unbelievable excesses and the unbelievable stupidity of people that have taken 10 and 20-year bonds at incredibly low interest rates and are now sitting on trillion-dollar losses. I just can't believe that this bond market is going to unwind in a nice, steady, orderly fashion. I just don't believe that's going to happen, but nevertheless, I'll keep an open mind on that. So a disorderly unwinding of the bond market would certainly raise the fear, and it would certainly help stoke inflation as well, because that means that yields will go up more quickly than otherwise, and that will certainly feed through into inflation. So what are the factors that would negatively impact bonds and cause that unwinding of the bond market to be a bit more disorderly? So these are just the ones off the top of my head, and I put them down not to indicate that they're going to happen, but just to point out that there are a number of potential triggers, and for none of them to come to pass, I find a little bit hard to swallow. So let's have a look at what that could be. The US economy is certainly trundling along quite well, and that just reinforces the trend towards higher interest rates. The Fed is almost certainly going to move in December on raising rates, and then probably continue that rate rising cycle going forward. I suspect at a fairly slow rate, but nevertheless. But the market, of course, has taken over before that and has sold off bonds aggressively and pushed interest rates up. Second one is inflation expectations from all the fiscal stimulus. Now, it remains to be seen how much Trump can actually get done, but before the US election, the Bank of Japan and the ECB were talking about moving away from monetary stimulus of printing money and moving towards more direct government stimulus. So that pumps money into the economy and is going to lift inflation, whereas the monetary stimulus didn't. A greater supply of bonds to fund the infrastructure building that Trump wants to do. The only way he can do it is to issue more bonds. And what that's going to do, the increased supply, is going to push prices down and therefore yields to go up, especially if central banks don't step in as the buyer of the bonds. So to me, it's pretty fundamental economics. The next thing is there's definitely a significantly lower level of liquidity in all markets, in the bond market, in the derivatives market, thanks to regulatory changes since 2012-13. So what that means when you've got less liquidity is that if there is a bit of a panic, that prices are going to fall a lot further than they otherwise would because of that lower liquidity. I think that's a bit of a sleeping issue that's not getting too much recognition at the moment. And of course, the Fed rate rises themselves. So, and there's probably another half a dozen factors I could put in there. So I put that up there not to paint a doom and gloom picture or not to say that any of those things will happen, but I just believe there are so many potential triggers that could negatively impact the bond market that I think you've got to acknowledge that it's a pretty realistic probability. And if that happens, then gold will do very well in that environment. Now, as with the stock market, sentiment and contrarian positioning pays dividends, and this is the practical reality in the futures market. The speculative longs have been reduced for the third week. So these are speculators who are trading gold futures on very high leverage. The net position, so that's the longs minus the shorts, the net position peaked at 286,000 contracts in July of this year. We're now down to 104. It's almost cut itself in thirds, if you like. That's a very, very substantial reduction, and it's now back to the levels that we were at in February, particularly the short position. So from a contrarian point of view, this is good. Speculators have become very negative, and we're now down to, we've got rid of all that speculative froth that I've been speaking about since June, July. It took a while, and it took a couple of fairly nasty plunges, but finally we've got rid of all that speculative overhang in the futures market, and that's potentially a positive. And I think from here, the downside risk in gold is far less. I think the downside risk in gold is minimal, and the upside potential is substantial. That doesn't mean that either of those things will happen, but that's just the way that trade sits at the moment. The other thing that I'm encouraged by is that silver is outperforming gold, which is unusual. And it's quite possibly related to the fact that we have got a supply deficit. So the demand is exceeding the mine production and the recycling of scrap silver. And the latest report that I've seen from HSBC argues that silver supply deficit will get even larger in 2017. So perhaps that is what's driving some of this at the moment. Now, the impact of the Italian referendum tonight, look, it's just a whole bunch of unknowns. I could speculate about what might happen, but it's pointless. We'll just have to wait and see. But I've just got a sneaking suspicion that we're not going to see the same impact on gold that we saw with Brexit or with Trump. You know, too many people are expecting it, and generally when that happens, it doesn't happen. Gold was sold down by another $6 on the week. As I said, silver fared better. The stocks continue to form a base, and stocks are definitely doing better than the metals. And on Friday night, we actually saw some very significant rises in US silver stocks. There was a couple of them that were up by 8 and 10% on the night when silver and gold were effectively flat. And now you've heard me say many times that the gold and silver stocks will lead the underlying metals. And so I take that as a bit of an encouraging sign, but you know, let's not get carried away with it. We've had a pretty tough 4 or 5 months since gold and gold stocks peaked out in the middle of the year. So it's about what I've been talking about now for weeks and weeks, and it's about striking a reasonable balance. Don't make heavy bets on anything. So let's take a look at gold and silver. So there's US dollar gold. It's been a very, very sharp decline. This is the 9th of November, so that was the day of the US election. You can see that gold roared up to 1350 and then in the same session fell apart, and it's been downhill ever since. We've now completed 1173 was the Fibonacci retracement level that I was looking at, and we closed right on that on Thursday, and we closed slightly above it on Friday. So at this stage, it's holding. We are oversold on gold, that's for sure. And so if it is going to bounce from here, then, or if it is going to bounce, then this would be a good place for it to bounce from. Turning now to silver. You can see silver has just been quite a bit steadier in the last week or 10 days. There's gold, definitely still trending down strongly. There's silver looking much better, and certainly that followed through with some of the silver stocks on Friday night. Let's look at GDX. So we got down below this middle support that I thought would be as far as GDX would go. We got a bit lower than that. We didn't quite make it to the 61.8, but we got reasonably close. So hopefully the worst of this is past us. This is GDXJ, which will also reflect some of the silver stocks a bit better than GDX will. And you can see that one has really based out and looking a little bit better over the last week or so. Turning now to other commodities, copper held its ground around 262. And I've been talking the last few weeks about this likely deficit in 2017-18 continuing to build, and that's a positive for copper stocks. And we've certainly seen copper stocks around the world do quite well. Now, the OPEC decision was favourable, and crude oil surged to almost $52. But it wasn't just OPEC. Price had disconnected from the US dollar before the OPEC decision. The US dollar has gone up to such a degree that oil really should have been off, on my calculations, around about $8 a barrel. We should have been down around 40 or possibly even 38 based on the US dollar rise over the last few months. That didn't happen. Crude oil got down to 40, 44, 43, but then surged back up again. So there's a positivity returning to this market. Now, I'm not getting carried away with this OPEC deal. I don't believe it's going to hold, but the point I'm making is that outside of that short-term impact, I believe there are other dynamics that relate to the basically the balance between supply and demand that are starting to turn positive for oil, and certainly energy stocks are reflecting that as a leading indicator. There's the spot copper chart, no real net movement over the last couple of weeks there. So just to wrap it up, the overall strategic approach, I know that a lot of Australian traders and investors are getting a bit put off by some of these brutal price plunges that we're seeing, and we've seen a lot of them. And it's across the board. It's not sector specific. It's any stock that misses expectations by even a small amount gets a fair old whacking from the market. There is a solution, is the point that I want to make, and I've been introducing this, as members would know, particularly into the investor membership. There's things that you can do to insulate yourself from these big individual stock plunges. You don't have to just sit there and be a victim of it. And you can also insulate yourself from general market volatility as well. And I'll get to that on the next slide. So you can do both things. You can insulate yourself from the individual stocks that might move 20, 30, 40% in a session. And you can also insulate yourself from general market volatility, which is definitely coming. We are going to see several bursts of substantial volatility, I believe, in 2017 and beyond. It's really important. The psychological side is so important. You've got to stay grounded and respond to the facts. There's a lot of sensational media out there at the moment, and if you get drawn into that, you're just going to end up in a hell of a mess. So make sure you're responding to the facts, and that's what I'm trying to do through these weekend videos. Just try to give you the facts as I see them, so that you've got a balanced view and you can make your own decisions. And I can tell you that if you can manage your emotions better, it'll make a massive difference in your overall returns, between the poor returns that most people get and the really good returns that are possible. There's always going to be dire predictions in the media. That's what they do. It's what they're there for. So you can't avoid that. The key is how you respond to them. And just as an example, I'm sure you've been reading and hearing for several years now that China was going to crash, that all of their real estate market was ridiculous, and ghost cities, and unbelievable government debt, and it was all unsustainable. There's been doom and gloom about China now for a couple of years. This is a chart I saw this morning, which I thought was just so telling, and it shows the level of Chinese commodity imports going back to 2006. So it's working off a scale of 100 back in 2006. So the light blue line at the bottom is China's crude oil imports in millions of tons. The green line up the top is the iron ore imports in millions of tons. And the pink line in the middle is copper imports in thousands of tons. You've only got to look at that chart to see that the trends are pretty much unbroken. Copper is a little bit more all over the place. There's a few dips and plunges there, and that's because there's a fair amount of speculative activity goes on in China with respect to the copper market. But if you look at oil and you look at iron ore, you'd be hard pressed to conclude that China's about to crash when they're importing at that level. So, picture tells 1,000 words. There it is, right there, I believe. So a lot of the media stuff is just absolutely overdone, and you've got to find a way to ignore it. Now, just to make the point on what you can do to avoid general market volatility, and what you can do to avoid at least some of the market smashing that is handed out to individual stocks. The first thing you can do is don't have a big exposure to any one individual stock. So, I mean, that's vital. But there's also a class of stocks in Australia called LICs, listed investment companies, and there's about 70 or 80 of them in the Australian market. Most of them are only average performers when you look at their results, but the elite ones, as in any field, do very, very well, and they outperform the others by a considerable margin. Now, I can classify LICs into three broad areas. One of the LICs that they're just stock pickers, but they tend to be specialist managers in certain areas, and they have somewhere between 60 and 100 stocks in their portfolio, which means that you've got a lot of diversification in there. Any one individual stock does not significantly impact the overall value. So that's one class. The second class is what's called market neutral. So they're long, short funds at the same time. They're long the stocks that they believe will do well, and they're short the stocks that they believe will not do well. And these sort of funds will tend to underperform in a strong bull market because they've got the short exposure, but they certainly do insulate you very well in general market turmoil. And the third kind, and this is really gaining traction around the world, and it's just starting here in Australia, is LICs that focus on what's called alternative asset classes. These are quite specialized asset classes that are not stock market listed assets. And then there's also, of course, other LICs that just deal in normal stocks, but they're unlisted stocks. So the message is there are things that you can do. There are certainly other avenues where you can go, and members are starting to to get their head around that. The process also, you can gain some significant advantage. You can buy these LICs when they're undervalued relative to their net asset value. And then you can also actively manage them. You can take some profit when they get overvalued. So just buying into LICs as a class is not a particularly stunning thing to do. So if you just go out and buy some of the LIC majors, then you'll insulate yourself a little bit, and you'll get an okay return. But you can do so much better by building up a portfolio in those three different classes, and by understanding where those LICs are relative to the value of their underlying assets, buying them when they're undervalued, taking profit when they're overvalued. You can gain a significant amount of leverage. So to me, that's a very interesting and exciting part of the market. So for anyone who is a non-member that is interested in that way of attacking the stock market and gaining some above average returns, then there's my contact details. We'll see what happens tomorrow. We'll know, I guess, before the Australian market closes tomorrow what the outcome of the Italian referendum will be. In the short term, it might go either way. I don't know. We'll just have to wait and see. That's it for this week. Cheers.